Hello everyone. On behalf of the Sustainability Reporting Standard Board of I, CA Priyal Karani, extend a warm welcome to all of you to 32 session of our webinar series, Demystifying Sustainability, Catalyzing Growth. Today's session is centered around a critical theme, embedding ESG at the core, risk management blueprint for the next decade. We are honored to have with us CA Preeti Parasavlaji, Chairperson SRSB, our esteemed speaker CA Delzad Dinyar Tanas Jivashaji. Let us now begin. I would like to invite CA Chandni Chintan Dedia to kindly take the session forward.
Thank you, Priya. Good afternoon, everyone. Let me give a quick introduction of our today's speaker, Mr. Dilnas Dinyar Tanas Jivasha. We become the district ACA, ACS, ACMA, LLB First Class MU, DISA ICAI, FIII DIRM ICI Air India 1 is highly accomplished professional with 23 qualifications and certifications and over 19 years of diverse experience across risk management, ESG and climate risk, business continuity planning, finance, legal and compliance. A fellow of the Insurance Institute of India and a member of ICAI, ICSI and ICMAI, he has led several pioneering institutes in enterprise and ESG risk management at ICICI Lombard General Insurance Company Limited, where he serves as a Deputy Vice President, ESG Risk Management, Climate Risk Management, and Investor Relations. Mr. Jivisha has received multiple prestigious awards, including the CFO Next Award 2021 to 2025, CA Business Leader 40 Under 40 by CNBC and ICAI, Risk Manager of the Year Legal Era, International Prithvi Award 2024, and the CMA Corporate Achievers Award 2024, among others. A thought leader and a subject matter expert, he has actively contributes to national and international forums such as ICAI, ICSI, CII, Ashokam, and BIS, and continues to drive innovation in the fields of enterprise risk management, ESG, audit, and corporate governance. Over to you, sir.
Thank you. Thank you very much, Chandni and Priyal, for the introduction. And I wish to take this opportunity to compliment the superb initiatives being taken by Ms. Preeti Savla and Dr. Singhal as part of the SRSP board, as well as the fantastic work Team SRSP of ICAI is clearly doing in terms of ensuring that the novel topics which are in the space of ESG, sustainability, BRSR, etc., is disseminated to the greater community so that they realize, appreciate, and understand the overall importance of it. And in many ways, in times to come, this is going to be a very critical and important area to look at and explore. As mentioned by Chandni, my name is Delzad Jivasha. I am responsible for heading ESG risk management, sustainability risk management, investor relations for ICICI Lombard. I've also headed portfolios in the past, such as enterprise risk management, etc. One thing critical to note is that I hope my presentation is visible.
Yes,
okay, fine. Just a moment. I'll just... Right. One thing fundamentally important to note is that more often than not, and certain things are more part of legacy, the way they play out, that people tend to think that risk management essentially means something which is always going to peg back your progress, or which is always going to tell you to do or not do X things. And that is the first mindset change that needs to come in, because again, the objective is not to basically or to essentially just be maybe the quintessential fault finder. It's more to work progressively with the business, work in a very collaborative way, and then essentially ensure that the business achieves their objective. At all points in time, risk management exists because the business exists. If the business will not be there, what is risk management going to do? They might as well pack their bags. Risk management is not about always trying to tell you that what you're doing is right or wrong. It's more about being that friend, philosopher, guide whom you can go to if you ever want genuine, dispassionately fair advice on any matter. All of y'all think through for a moment. If y'all had to go for advice to anybody in your life, whom are y'all going to go to? Whom would y'all like to go to? Just visualize the answer in your mind. Maybe some of you may say parents. My answer would be parents. Some of you may say maybe your spouses. Some category of you may say maybe your friends. Some may say subject matter expert. Some may even be thinking it depends on what is the matter at hand. On that basis, I will decide whom I want to go to. All said and done, no matter all of your considerations being in place, one thing is very clear. You obviously have a element of trust in that person, whosoever he or she is, and you're going there because of that trust factor being there. And that is exactly the trust that you need to put on your risk management functions, because basically they essentially exist to ensure that you succeed in your objectives. One very important thing to note is that essentially when you talk about risk management, traditionally, it was always something that you used to tend to think that, okay, what do I mean by risk management? Maybe I mean some level of operational risk management. Maybe I mean some level of audit. Maybe I mean some kind of credit risk management or market risk management, etc., etc. So all said and done, those areas still continue to hold importance. Those areas still continue to have cognizance in the overall scheme of things. But an area that has increasingly emerged in the recent past, and which I believe will continuously grow in times to come even more, is the entire ESG story. And this session today is not about telling you what has happened in the past. Neither do I want to make this into a session which is only focusing on the theoretical side of the coin. No. The objective is that what does the next decade hold for us from a risk management standpoint? And above all, the important theme for today, that when we talk about ESG or environmental social governance, how are we essentially going to embed the same into the overall scheme of things? How are we going to basically integrate ESG with risk management and get them on the same page? Because that is what is fundamentally important for risk management even to succeed in the coming decade. What we will look at is situations and scenarios as to how we can marry both. Because in many ways, from where I'm coming, if you ask me, they are two sides of the same coin. I am not, or rather, I have never ever looked at ESG and risk management being separate. I have personally always looked as both of them being like your right and left hand, which need to work together. It cannot be that the right hand says, I don't know what the left hand is doing. or for that matter, the left hand's taking a claim that I've got nothing to do with the right hand. It doesn't practically work that way. So our session today will aim at integration of these forces. In terms of what I propose to cover is maybe some kind of an overview or background of ERM, what the meaning is, what are some of the key facets. Then again, ESG focus areas, what can be a good organizational governance structure, how do you integrate core strategies? That's very important. Again, a critical area, which is climate risk management frameworks, which one can adopt, which is increasingly gaining a lot of traction and a lot of prominence in times to come. One thing is very clear, that no risk manager or no risk management team in the world will ever tell you not to take risk. No. That is again a mindset challenge, where we tend to think that all that risk management team does is try to say that don't take risks. There is enough or more maturity to assess, to understand and know that there is no business in the world which is devoid of risk. No business in the world. At the end of the day, every business has that element of risk in it. It has always had and will always continue to have. But the point is that just because risk is there, that does not mean that you will be blindsided and just go all out. The question is, do you look before you leap? The question is the no surprises policy, where you do not want surprises coming that, oh my God, I didn't know this, or oh my God, I didn't see this through, or that I could not visualize this coming. That is not something we want to see. What we want to see is a culture. What we want to see is an environment where basically we essentially aim to take calibrated conscious calls. And why do you need risk management? Because even if you have to grow, you can't grow aimlessly. You have to grow profitably. So what is very important is that, do you have a healthy top line? Are you contributing to your bottom line? And what is the extent of balance sheet protection that you have? All of these three put together are critical, and that's why you need that risk management. You look at any of the Fortune 500 companies of the world who have been in that position for a prolonged, sustained period of time, and somewhere down the line, you'll realize that it's not that they didn't see bad times. They saw bad times, but they knew how to navigate around it, because they never thought that nothing bad can happen to me. They were always mentally prepared that something haywire can go. But even if something haywire ends up going, you always knew that you will take good care of it. You always knew that you will suitably protect it. There was a stage that typically, even when I would be part of various conferences, it was exceedingly common for people to, thank you. Thank you. It was exceedingly common for people to acknowledge the market leaders. But all of a sudden, what happened? From being in a stage where you actually got up to acknowledge the market leaders, to actually refusing to recognize them, in the span of few months, what happened? Why such a sea change? This happened because somewhere down the line, they thought that, you know what, risk can only happen to somebody else. It cannot happen to us. हमें कुछ होगा नहीं, it cannot impact us. That was wrong. That was very wrong. And the problem which happened with some of those organizations is that your risk management failure happened. Had your risk management failure not happened, this would not have been the norm. What is the solution? The solution basically is enterprise risk management, which helps the organizations to plan and tackle their risks. And now, the biggest risk factor which is emanating for the world is ESG, which is environmental, social, and governance. A three-letter word which basically encompasses an entire organization within its scope. It's not that it leaves out any area. It's a three-letter word which will integrate everything within its purview. Risk is the probability of an event which impacts the attainment of objectives. So anything which tomorrow can go on to impede your objectives or cause any form of challenges for you, that is basically a risk. Now, again, when you talk about risk, risk is essentially measured by two factors. You have the first factor, which is called probability or frequency of occurrence, and the second factor is what you call severity or impact of occurrence. Now, I would like you all to carefully think through, take this pause to understand what do you believe is the meaning of probability or frequency, and what do you believe is the meaning of severity or impact. Probability or frequency essentially means that how often is an event occurring, and severity or impact means that once it has actually occurred, how much is the financial impact that can accrue to you. Yeah, it's a mechanism an entity sets across the whole organization. It enables the organization to have all the risks looked at together. And finally, ERM involves setting up a framework wherein the functional responsibilities and requirements are very clearly laid out from the top level to the bottom level, requiring reporting, controls, and communication. So, the fundamental factor is that when you talk about enterprise risk management, the word we've used is enterprise risk management. We haven't used the word departmental risk management or unit risk management or functional risk management. What we've used is enterprise risk management. Why? Because you cannot look at risk only in the lens of a function or a unit. You have to look at it in the lens of an entire entity or an entire organization. Today, a finance team cannot say that even if adverse media publicity happens about the organization in the media, why should we care? eventually it is the sales guy who has to go and face the customer. No. If your organization is in the media for the wrong reasons, you can prepare pristine, clean financials. Nobody will believe you because your organization is in the news for the wrong reasons. The best talent will not want to join your organization, which will again be a problem even for HR in terms of attracting talent to the organization. So when you look at a risk, you have to look at risks holistically. So enterprise risk management is the practice of identifying potential risks in advance, analyzing them, and taking the required precautionary steps to reduce that risk. Now, how do you distinguish between inherent risk and residual risk? How do you? Pause and think for a moment. How do you believe the two differ from each other? What is so different between inherent and residual? Or is it that they mean the same thing? What happens if a large payment had to be made only by one person? What happens in that eventuality? Only one person checking, validating, and making a large payment of, say, 200 crores to a supplier. What happens then? What is the level of risk? The level of risk is high. But again, assume for a moment that I introduce a maker checker reviewer mechanism. Now, what happens to the level of risk? It becomes on the low side of it. Why? Because you brought in a control. That's why. So, at the first point in time, when there was no control, that time the risk was high. Later on, at a residual level, it becomes low. I think there's a bit of a problem with the PPT is hanging. Yeah. So this is an independent management function focused on value addition. We just discussed that. Now, four fundamental facets of risk management is risk identification, risk assessment, risk evaluation, risk treatment, and monitoring. So these are four fundamental aspects of risk management. I would like you all to spend a minute to assimilate what you all are seeing on this slide. Now, today, ESG, as we refer to as environmental, social, or governance, this is something which increasingly today gets asked to me by our investors. So, very simply put, if an organization is not very good with its sustainability or ESG, very simply put, investors are not willing to put in money in the organization. Now, from an ESG standpoint, amongst other areas, 4 key areas which stand out are climate change commitment, diversity and inclusion, responsible investment, governance and enterprise risk management. Now, ESG is again a commitment by your entire senior management C-suite executives. It's not just about saying that I will only look at one leader to drive ESG. No, ESG impacts every single area of your organization. So all the leaders need to come together and decide what will they do about anchoring the ESG initiatives of the organization. One critical part is commitment to net zero carbon emissions, investing in renewable sources of energy, as so the climate change governance, and equally supporting the government in their initiatives. So increasingly, when you look at maybe some of the larger corporates of India, they are continuously giving these disclosures in their ESG reports with regard to what is the percentage of energy that they are using from renewable. And they even take targets to continuously up the ante in times to come and procure more of renewable energy. And these targets are put out in public domain in their ESG report. For a very long time, organizations used to come out with an annual report. Today, a very large component of organizations, along with coming out with an annual report, are coming out with a standalone ESG report. And along with coming out with a standalone ESG report, they are equally, at all points in time, integrating ESG even if they don't come out with a standalone report. The commitment to net zero carbon emissions is extremely critical. And that again brings back to what I said on the earlier slide, that all the C-suite members have to come together. Why? Because essentially, carbon emissions comes in every area of your operations in some shape and form. And that is why when a target is taken, every leader of the organization needs to pledge commitment towards that target. Only then it will happen. The other important area of ESG, which is diversity, equity, inclusion. Most of the time, many of your organizations who are listed are subject to ratings in ESG which are given by bodies such as S&P, Sustainalytics, MSCI, etc. A very important area which even these rating agencies look at is that what is the balance of male-female employees in the organization? Do you have effective organization-wide policies to maybe support physically abled people? Are you as an organization encouraging female employees to join back the workforce after completion of the maternity leave? there is a host of different diversity metrics which organizations are putting out to the world at large. And what is also getting looked at is that to what extent do you have diversity in representation, even in your critical management committees and board committees. Commitment to principles of responsible investment. Responsible investment basically means that today, particularly many of stakeholders who possibly could be attending this webinar from the BFSI side would be well aware about the fact that the service sector has a very large pool of savings of the general public. What they do with that savings is invest that money. Now, question is, where is the company investing the money? Are you investing money in maybe a company presumably which is possibly encouraging bonded labor? Or are you maybe investing in a company which is maybe not the best when it comes to carbon emissions in the atmosphere? Are you maybe investing in a company which is not giving the required levels of cognizance to ESG? So when you talk about ESG, what is critical to understand is, okay, it's not just about ESG in your internal operations, like say carbon commitment or diversity, equity, inclusion, whatever. It's equally that if you have a pool of reserves available with you, which you are investing in other organizations, from where you get returns, and where you are an investee company, you've got to make sure that you invest your money in organizations which are truly compliant and following the principles of ESG. Otherwise, it becomes a scenario that you are not walking your talk. Now, again, when you talk about governance and risk management, you talk about board approved policies and procedures. There has to be robust internal governance and a disclosure of emerging risk areas as well. The entire governance structure needs to be framed in an effective way. How will you ensure communication to the board? How will you ensure communication to your investors? Again, your entire cadre of investors do not only want to know what current risks are, they equally expect disclosures around what your emerging risks are. What is going to hit you in the next decade? Would it be something like maybe geopolitical risk or supply chain risk or cybersecurity risk, anything? And what steps have you taken to ensure that you minimize the impact of that? And even look at building board approved policies and procedures around the same. This is what a typical governance structure looks like. So this can be a typical governance structure which a board or a risk or an audit committee can establish to equally look at overseeing ESG related risks. You have an internal ESG committee of Mancom members who need to meet every month to review assess the overall risk paradigm. You have to have your internal risk management committees and equally set up a board level ESG committee. First, we used to only hear of committees like audit committee, board nomination and remuneration committee, etc. Now, even a board level ESG committee has come, where basically you have got at least it's a 9-member committee, 2/3 of independent directors, chair being a independent director, which eventually rolls up into the board. So that is the extent of importance and governance structure that you set around it, where actually the board has decided, okay, let's have a subcommittee of ours only to look at that. But again, you cannot be saying that that committee will only look to do that. They are going to meet once in 3 months, which is not enough. And that's why you've got your internal management committee. And this committee meets every month. The targets which are given to every stakeholder team. And every stakeholder team needs to come to the committee and present before your entire management committee whether they've been able to achieve the target. And if they've not been able to achieve the target, answer why you could not. And how will you remedy the situation? Eventually, there is something called tone from the top. If you don't follow tone from the top, it's a problem. It's definitely a problem. How we integrate and marry the two. And what I am about to cover is essentially exactly that. Remember one important aspect here before I proceed to this segment. Do remember that there are never any bad questions, okay? There are only bad answers always in life. Questions cannot be bad. Answers may or may not be bad. So I would encourage each of the members who are on the call today to make use of this initiative which SRSB has taken and ask the questions. We will ensure that, by the time the session concludes, all your questions are answered. But do not have any doubt in your mind with regard to anything that you may want to ask. The whole idea why SRSB is taking this initiative is exactly to ensure that clarity on the way forward is there, and at a fundamental level, there is zero confusion on the core concepts. So just a 2-minute small deviation from my end to encourage all the members who are on the webinar today to ask your questions. Do not think it may be judgmental or not be judgmental or whatever. And yes, to the maximum extent possible, you can be rest assured we'll try to address every single question. Very clear on that. So I'm going to be sharing a presentation. Just a moment. Seems to be a bit of a challenge on the presentation. Just give me a minute, friends. I'm just trying to. Seems to be a bit of a problem with the screen sharing. I'm just trying to fix that. Yeah. So the first step is integrating ESG into the overall risk and control self-assessment activity within the function.
So 1 minute. Can we put it on the presentation mode?
Is it better now?
Perfect. Thank you.
One
Perfect.
aspect is identifying that entire risk and control repository, including ESG risks. Now, again, this is again a factor that traditionally, when you talk about risk and control self assessment activities, when most of the teams were doing the risk and control assessment activities, the inherent focus used to always shift a lot on operational risks. So, operational risk was like, big, was like the starting and end point of everything. But today, what has happened is that you are trying to include equally ESG and climate risks in your library. So if your library is maybe 100 odd risks, we can see a trend that the count of risks on the ESG side or the climate risk side is increasing as a proportion of total risks. So that again is a mindset change that you equally need to start evaluating that as well. Again, it is very common to have process walkthroughs during process audits before you begin your entire process audit or before you begin a risk and control assessment activity. Now, there was a stage that pretty much during the earlier period, all you looked at was trying to understand the core processes. But there, you equally need to understand potential risks as well. How do you look at it? Even look at assessing the severity and the impact of occurrence. And thereafter look at it at an inherent and a residual level. So just like we discussed likelihood and frequency assessment and severity, you look at both at an inherent level and a residual level. and integrate that equally so that a roll up can happen eventually at an organization level. Now, when you look at focused key risk indicators on ESG risk management, this is a very important aspect which all of you all need to take utmost and full note of. Key risk indicators are believed to be indicators which give you an indication, as the name suggests, that possibly whether things are under control or whether things are going wrong. So what's important is that you decide on certain key risk indicators which are focused on ESG. You crystallize them post Mancom level discussions and present those indicators through dashboard dials to the management committee. So you try to do Mancom level discussions as to what will be your red, amber, green. So key risk indicators are nothing but, how do I put it? Maybe setting up core acceptable or non-acceptable limits. I can use technical jargon as well, but I want to keep it simple so that the message goes through. So indicators will be those formula or those matrices, so to say, you will develop, which will give you that perspective as an organization as to whether directionally you are correct or not correct. Now, let me try and give you an example of what an indicator essentially looks like. Say, for example, I have 100 odd employees in my organization, out of which 10 are key employees. Okay. Now, out of those 10 key employees, if 2 leave, I may be okay with it. So on a percentage basis, it works out to 20%, 2 out of 10. So 20% becomes like my acceptable threshold, or what we in risk management say, the green zone. If it's between, if 3 to 4 people leave, I would worry a little. Although I may not press the panic button, I would worry a little. Okay, why are so many key employees leaving me? So when you talk about 3 or 4, what gets important is that becomes like your amber zone. And greater than 4 becomes red zone. Greater than 4 becomes your non-acceptable level. Like that. Practically, it's never going to happen that you will directly cross 4. You will begin with maybe a 2, graduate to a 3, then go on to the 4. That's the practical side of the coin. So typically that becomes very, very important. Because what you want is a scenario that you have enough time to peg back if anything happens. Now, traditionally, the biggest challenge was that the only time you looked at your key risk indicators was essentially in the space of, say, an operational risk management or a credit risk management or a market risk management, etc. But now you equally look at ESG risk management. And you equally look at having indicators in place for each of the categories of either environment or social or governance. And these indicators get presented to your board of directors every single quarter. And before they get presented, they are equally presented to your own internal management committee every single month. This is where the maturity curve needs to go up. And key risk indicators need to be set. That will bring a lot of discipline into the equation. Because people, you will start fixing accountability on people. That is how you can even integrate ESG into your overall ERM framework. By inviting them to present. And particularly if the indicator goes from green to amber or is in amber or red, you've got to be very clear with it. Generally, what we've seen over a period of time is that the number of indicators that you essentially use for your internal committee are maybe more in number than your board committees. Because there will be a lot more granularization for your internal committee levels. Pretty much from a board standpoint, it may not be the most appropriate thing to become too granular. But, as they say, the sum is more than the parts. So at the same time, it becomes important that somewhere down the line, essentially in your internal management committee meetings or internal governance committee meetings, you need to look at having a higher count per se of that, of the indicators. We've seen this discipline come in at a practical level, that the moment you introduce indicators into the equation, the moment you ask people to give mitigation plans where indicators are breached, the moment you ask people to start tracking actionables, and the moment you make them come and present to your management committee, automatically you start seeing a culture getting built up. And the moment your culture builds up, that is 80% of the battle won. Very simply put. Another aspect which is of fundamental importance is to do that level of capacity building. Eventually, aspects like ESG and BRSR are technical aspects. It's not always that there is resistance at the auditees end, or for that matter, there is resistance at the stakeholder team's end. It is equally that they need to be sensitized. They need to be briefed on what's important. Because as a chartered accountant, you may know a lot of things. You may be aware of a lot of things because of either your educational background or your training or your day-to-day experience. But there needs to be sensitization around the fact that the person at the other end is not all that up to speed. So if you have to undertake a journey which is going to stand the test of time, you'll have to be very careful about it. Because you'll have to first ingrain concepts in the minds of your key stakeholders so that they do what they do. We've got a concept called internal capital adequacy assessment, where definitely what you try to do is basically project scenarios the way they are. And if those adverse scenarios were to materialize, or rather than saying the way they are, maybe what can a more appropriate way to say it would be what can be the adverse possible scenarios that can play out against you as an organization. So ICAP or internal capital adequacy assessment process is about enlisting those scenarios or enlisting those factors and then trying to assess here what is going to be the impact on your capital over the next 4-5 years if a materially adverse scenario was to occur. Now, the occurrence could either be based on past experience or it could be something entirely new. It's really not necessary that you need to restrict your vision or horizon only to something that's already happened. No, that's not how you look at it. But what is important here from an integration standpoint is that even earlier, your ICAP used to essentially be focused only on the three cohorts of credit, market, operational. So that's where it began, that's where it ended. But today, ESG is making its presence felt. In terms of climate risk management scenarios, in particular, being built into ICAP and even public disclosures happening around the same. And with companies coming out with clear disclosures that if an adverse climate risk event was to happen, what is going to be the impact on their capital in times to come? A very important aspect in the entire ESG journey is not just restricting your horizon to what you do as an organization. Organizations invariably are getting in that zone that they to a large extent focus on outsourcing their non-core activities. And in a way, it's not wrong. Why not focus on your core and leave the non-core to somebody else? It's not a bad way of thinking. The only point I'm trying to make is you have to think who are the vendors you are empaneling. And I got to compliment the initiatives of SEBI also in this regard, that as part of their BRSR initiatives, they are even talking about value chain integration in terms of upward and downward value chain integration. What is upward and downward value chain integration in BRSR? It is nothing but looking at things in the lens of your vendors and your customers and rolling all of it into you. And that itself proves one thing, that ESG is not something you look at in silos. You have to work collaboratively. You can't say, I will only bother about ESG from my side and let me work with either customers or for that matter vendors who basically don't care at all for ESG. Then again the old problem of greenwashing comes in, where basically it means you're only doing things for the sake of doing it. Actually, the level of commitment is not there. So to establish that level of commitment, it's extremely important that you empanel vendors. and make them believe that we are there to stay as an organization and extend that ESG not just to our practices, but equally to our vendors, equally to our customers. You again look at assigning appropriate weightages to ESG in your risk ratings for your vendors, conscious call to be taken to work, and a fine balance to be struck with commercial dynamics. Like we discussed in the earlier part of the presentation, you equally look to take certain calibrated calls and maybe sign up to the principles of responsible investment and make that call to exclude certain cadre of investments. So now, even if you go through the BRSR or the ESG reports of many stakeholders, you tend to realize that very often the organizations are coming out and saying, okay, we will not work with an X set of people or we will work with an X set of people. So they are very careful with their investee company selection. They ensure that we are signatories to the PRI, that is Principles of Responsible Investments. What you're trying to do is proactive shareholder activism. These are just some few fundamental aspects with regard to what the expectations of PRI are. Now coming on to again a very critical element with regard to business sourcing considerations. More often than not, we tend to, or rather certain cadre of stakeholders tend to believe that if I'm getting business, let me close my eyes and take it. Maybe they've got their own considerations to look at for very valid reasons. But today the day and age is evolving. Where if I was to give a best example I can give you is that many of your global reinsurers have pledged commitment to moving out of the coal business by an X date, which means that after the X date demarcated by them, if there is any entity which in some shape and form is using coal, the reinsurers have taken a call that we will not give reinsurance cover to that cadre of clients. Now that is a strong message because you're in one word, you're saying I mean business, and you're giving them a glide path to move away from coal by that point in time. If they still do not move away from coal, very clearly what they are saying is, okay, if I lose business, I lose. If my profit even comes down, let it come down. But to build a sustainable future, I will take certain calibrated business calls. And I see that happening in the coming decade. Even more. And needless to mention, since we are in an integrated chain, when one party begins that decision making, automatically it percolates to the others. We know that when it comes to risk management, the best in class practice is ISO 31000, with auditors placing a strong focus on assessing ESG integration with ERM. Now, this should be leveraged by organization to effectively ensure that within the scope of ISO 31000 also include ESG and climate. Why not include that? That should also get included. So that's another way you look to try and integrate even the ESG and climate risk story with ISO 31000. Now, even if you look at your entire climate change risk management story, which is increasingly gaining precedence, the Task Force for Climate-Related Financial Disclosures is one of the best-in-class climate risk management frameworks that you can use. And of course, we know now that it has got transitioned to ISSB 1 and ISSB 2. But personally, if you ask me what my personal opinion on it is, it's largely, I don't know whether it would be the best way to say old wine in new bottle, but it essentially builds on the principles of TCFD. So I think it's a fantastic, beautiful framework. which is built on the four broad cohorts of governance, strategy, risk management, and metrics and targets. Because we want an annual status report which addresses the progress. So we need the disclosures to be focused on four key thematic areas, which is the one that we've mentioned. Now, to further build on that, from a climate risk management standpoint, if you talk about, we discussed, okay, these are going to be the four broad categories. And even your investors essentially want you to adopt this. Now, if you talk of governance strategy, risk management, metrics, and target, let's do a bit of a deep dive into each one of them. From a governance standpoint, it's more about demonstrating whether you've got board level committees. You clearly call out what your terms of reference of those committees are. You again talk about maybe your internal executive committees for review of climate related risks and opportunities, ESG steercos. Each of these meetings also track the actionables and report them. That's very critical. So when you talk about the entire governance piece of it, what you are largely trying to do is focus around the organization's governance practices and give that sense of comfort as to how you are managing your mechanisms around climate related risks and opportunities. That's what you're aiming to do. Strategy is expected to again cover the actual and potential impact of climate related risks and opportunities on the organization. Where you even elucidate what is going to be the level of physical risk and transition risk. We spoke about ICAP, which is nothing but stress testing the impact of climate change. Now, the resilience of the organization strategy is taking into consideration a 2 degrees Celsius or a lower temperature movement, which is 1 degree and 1.5 degree to be mandatorily considered. Where you look at assessing the impact of the underwriting portfolio, and you maybe build that into your investment question as addressed to investee companies. The risk management section should talk about how identifies, assesses, and manage climate risks. How will you integrate climate risk into the overall risk management strategy? And you identify and manage your climate risk. When you are introducing new products, are you assessing the ESG impact of your new products? That gets very important. What is the level of risk modeling that you are doing to gauge the climate related risk? Again, something very important is the metrics and targets section, where what is important is, are you walking your talk? When you talk about walking your talk, the critical aspect is okay, you are making a lot of commitments, but over a period of time, you need to do what is called milestone achievement. What we mean essentially by milestone achievement is assume for a moment that you've taken a call to be carbon neutral by say 2030. You need to keep updating your shareholders and stakeholders as to how are you essentially going to manage the paradigm, and keep telling them at all points in time what your levels of progress are. You don't have to wait till 2030 to tell them, okay, now I'm 100% carbon neutral. If you were 50% as of 2025, by the time you get to 2026 or by the time you get to 2027, very clearly tell them, okay, from 50 I've graduated to 60, from 60 maybe I've graduated to 70, and that's how I am progressing. So when you take those metrics and targets, what is equally important is how are you pledging commitment in place of the entire earlier paradigm? How are you continuously keeping your stakeholders updated? How are you continuously making sure that at all given points in time, you are percolating those targets down to the lowest man in your organization till your board of directors? And are you on a milestone basis able to achieve what you set out in terms of clearly telling the stakeholders and the people at large that this is what I committed to you 5 years back and I'm on the track of achieving it? Otherwise, what happens is some of your marquee investors, they do come back and tell you, okay, look, this is the commitment that you gave, but it doesn't seem like you're delivering on it. Then it becomes a challenge because it ends up giving a perspective that we only made commitments for the heck of it or for the sake of it, but actually we did not succeed. So that's exactly why the fourth cohort of TCFD, which is basically metrics and targets, is very important because it aims at concentrating, it aims at focusing on 100% ensuring that you develop the mechanism. To achieve your targets. Okay, let me go on to the subsequent slides now. Now, one is that you tend to look at the metrics and targets in the lens of carbon neutrality with milestones and their achievement. Again, we spoke about the business underwritten with respect to coal plants, the targets, etc. We even discussed aspects about making ESG focused investments overall and reporting against the same. What we are increasingly seeing is that even now, most of the new products that are being introduced by many players are keeping ESG considerations in mind. And that is again something that is reported to the stakeholders, and it also has a direct bearing on helping people manage the climate change risk factor. We even discussed earlier about how the percentage of renewable energy versus non-renewable energy is getting disclosed, essentially as part of the overall climate risk cohort. And not only that, you are equally looking at trainings which you undertake for employees. Disclosures around that are also happening. Targets around that are also happening as to how on a phased manner you will look to cover the entire organization in the lens of climate change risk management. Today we see every new employee who comes in the organization mandatorily has to undergo a training module on climate change risk management, mandatorily has to undergo a training session on climate risk management, and even has to mandatorily undergo a small exam on climate risk management. And until the employees clear that exam, they are not regarded as confirmed employees, particularly to the new employees. Your old employees are anyway getting pre-soaked from time to time. So that is the extent of activism which is essentially expected here. Again, ERM and ESG largely focuses on being proactive. We have looked at different strategies whereby we can integrate ESG and ERM together and look at both at same sides of the coin. And the whole purpose of the session here is that how can you embed ESG in your enterprise risk management framework? Because if you ask me, I think the biggest risk that the world will face in the next decade will be on the space of ESG. The biggest risk that the world needs to address will be in the space of ESG. And you are increasingly seeing the number of CEOs who, as part of their investor briefs and investor calls, are increasingly talking about the ESG initiatives of the organization. So this becomes critical in terms of integrating ESG with ERM, which is extremely crucial for the long-term sustainability and viability of the enterprise, where you build a long-range enterprise which is focused on sustainability and viability. Build that together. So obviously I'd maybe end by saying that the old Chanakya Niti, which always my parents taught me since I was a kid and which holds good and true today, that you cannot discover new oceans until you have courage to lose sight of the shore, number one. And number two, let no man you transact with lose, so shall you not. Not for any other reason, but driven by the fact that at all given points in time, you have to make the other side win. It's only when you make the other side win that you tend to realize that you need to be successful to let your own function succeed. If there are functions like ESG and ERM which exist, they exist to make you win. They exist to ensure that the business achieves what they set out to achieve. Eventually, they are both part of the same coin and not part of different coins. Make no bones about that. So the focus of ESG and ERM both is to make the other side win. So I want to take this opportunity to once again thank you and thank SRSB for taking this initiative, and thank you to you all for joining in. And I would definitely encourage, like I said at the beginning, for questions to be asked. I've really enjoyed taking this session and guiding on how we can marry ERM and ESG. And I just like to give you maybe a couple of minutes to think through questions and send across your questions. More than happy to take them. So thank you very much once again. My best wishes to you and your family. And yeah, with that, I will happily hand it over to ICAI to maybe look at beginning the Q&A session in terms of just picking up and addressing all the questions which would have come from the members. So over to Team ICAI. Thank you.
Okay, sir, so I'll ask the questions now.
Yeah, sure. We can take up one question at a time. So we take one question, answer that, and then move to the next one. Sounds good?
Yes, sir.
Right. If any
What-
members have even more questions, let them send it as we answer the questions as well.
Okay, sir. So shall I begin now?
Yeah, it's okay to begin unless you want to give 2 minutes to the members to just assimilate their thoughts and if they want to ask any questions. I'm
Yes,
okay
sir,
with anything you're okay with.
Okay, sir. I'll ask the first question.
Yeah,
What
go
does
ahead.
it truly mean? What does it truly mean to embed ESG at the core of business and risk management frameworks?
What it means basically is that at every point in time before you take a decision, you have to evaluate the ESG considerations before you take that decision. Something as simple as when you onboard a customer, is that customer really good from an ESG standpoint? Or when you're onboarding a vendor, is he good from an ESG standpoint? Or when you're manufacturing products, are you ensuring that your ESG practices are built into your processes? Something as simple as when you're destroying old laptops, are you obtaining green certificates? So the realistic way to do that is to do that bit of drill down, that what are all the activities that you are doing as an organization or as a company, and demonstrate and prove that how you have ensured that at every nook and corner, at every stage, you have taken the ESG considerations into account and you have embedded it as part of your normal DNA. That's how you can embed it.
So the next question is, how can organization move from ESG compliance to ESG driven strategic assurance and risk resilience?
Wow, fantastic. Like the question. The way you can move it in a one sentence answer is by building the culture. I exactly can resonate with the gentleman or lady who would have asked this question. Okay, why they've asked this? But yes, the only way you can move it is to show to your C-suite executives why it adds value. I'll just give you a very interesting piece of statistic. People always tend to think that, ESG and business do not go hand in hand because of ESG, you have to incur a lot of cost. ESG means saying no to certain businesses. Let me tell you, and this data is available on public domain. It's absolutely available. That you look at the kind of return on equity which your ESG highly rated companies have given. Compare that with what is the ROE given by organizations who are maybe not good on the ESG side of it. And you will realize that these companies have actually done better. Now, why? Because they exactly integrated it as part of the strategy. So it is wrong to believe why people get into a compliance mode is because there is a perception brewing out there that ESG is not the most friendly thing for business to happen. That mindset needs to change. ESG and business can absolutely exist hand in hand without eating into each other, without biting into each other, and peacefully coexist to ensure that they collaborate and work together. So the way you move it is build up that culture. Talk to people, get them in the room, have those training sessions for one thing to be clearly known, that ESG is helping you take forward your business objectives. The moment the people are aligned with you, automatically you will notice a situation that before any major strategic decision is taken, the ESG side of the coin will be considered before taking that decision, including that if the strategy you propose to implement is not very good from an ESG standpoint, you will maybe look at plan B, but you won't go ahead with it. Yeah. Yeah, Priyal, the next one.
Yes, sir. Why should ESG be viewed as an integral part of enterprise risk management rather than as a standalone sustainability issue?
Because it's about looking at it together. If you look at it on a standalone basis, that means you are segregating it completely. Now, because you are integrating it in risk management, that doesn't mean that you are not looking at it as a standalone sustainability issue. You're still looking at it as a standalone sustainability issue. But what you're doing is, as an organization, when you're presenting your risk posture to the world at large, you're equally giving an X level of weightage to ESG. So to believe that you will only look at sustainability as a standalone issue rather than integrating it into risk management, no. You can achieve both together. The flip side of the coin equally is that, if you just give a risk paradigm to the world at large without looking at ESG considerations suitably integrated into the same, you're giving a very warped picture to the world at large. You're not giving a holistic picture to them because you're isolating one category. Jabki the entire objective of enterprise risk management, the whole purpose is to holistically evaluate every single risk, juxtapose them, and then present to the world. Over to you, Priya.
How can ESG risk be incorporated into existing ERM and internal control frameworks?
Exactly to the points that we discussed during the course of the last hour and a half. These are the steps that you take by integrating it as part of your risk and control self-assessment activity, building key risk indicators around the same, integrating it as part of your ISO 31000 potential assessments, thinking on the ESG side when you're doing a risk management assessment of your products, all your vendors. That's how you do it.
What governance structure should board and audit committees establish to oversee ESG related risk and opportunities?
Again, it was covered as part of one of the slides in the presentation, where basically we decided that as a first step, you should have a dedicated ESG committee comprising of 2/3 majority of directors, with the chair being independent. 2/3 majority again should be independent directors. There should be very clear terms of reference. Likewise, even the risk management committee terms of reference should be very clear in terms of integrating ESG risk as part of their terms of reference also. And within that, from a governance structure standpoint, you also have an internal management committee. You further have a steer co-committee of key employees who drive ESG in the company, and each of them eventually end up doing upward integration reporting. So that's how you basically achieve it, which is unanimously accepted as a best-in-class way of doing it. Yes, Priya.
How can chartered accountants and assurance professionals contribute to verifying ESG risk disclosures and improving data reliability?
Fantastic. So I think that there is a lot of scope, and what chartered accountants can do is ensure that the greenwashing doesn't happen, which is known to happen in certain cases. So I think chartered accountants have a very important role, and the role that you can play is, one, undertake the level of capacity building that's required, because to be fair, it's a new and upcoming field. So it would help to have the right level of, capacity building there, so that, it enables you to do a better job with respect to assessing the audits. And when you are assessing the audit, make sure that just like when the financial reporting is happening, you're doing your procedural compliance and substantive testing. Undertake the same even for the ESG side of it. And the good initiative that SEBI has taken with regard to making assurance of core BRSR factors mandatory for the top companies, that goes a long way in further amplifying the efforts of the chartered accountants, where the CA community can ensure that a thorough job is done in terms of the audit, and make sure that whatever reporting the company is doing to to the world and to the public at large is accurate, to look at things in the lens of professional skepticism. The company will say what they have to, but as the chartered accountant independent professionals, you have the entire bandwidth open before you to ensure that the reporting is accurate, complete, and integral. Yeah, Priya.
How can organizations integrate financial audit and ESG assurance to deliver integrated risk insights?
So again, organizations are doing that, where basically you look at and coming out with an integrated report, some part of which will be your financials and some part of it will be your ESG. Integration equally happens that you cannot be that your financials are talking North Pole and your ESG report or BRSR report is talking South Pole. For example, your BRSR core pretty much talks about what is your average outstandings or what is your average level of payables. Now that is again something that you have to ensure that your financials cannot speak a language which is different from what your BRSR report is stating. Or if your BRSR report is giving certain finer fundamental details with regard to your turnover and your profitability or your expenditure, it should tie up with what your overall financials are stating. So that's where the chartered accountant community can play a very important part in ensuring that whatever disclosures you've made on the financial audit side, they are completely aligned with what disclosures you are making even on the ESG report side or the BRSR report side. And ensure very often, and that's exactly why we are seeing this trend now, right? That organizations are appointing the same auditor for financial audit and the same auditor even for BRSR or ESG. Because the flip side to the coin is he knows what are the financials. So he'll be in a better position to equally assess that is there anything there which is fundamentally inconsistent.
What initiatives can ICI and other professional bodies take to strengthen ESG risk assurance capacity in India?
See, there are multiple things that can be done, and one is that ICI is already doing a fantastic job from where I'm coming in terms of the certificate course which they have, in terms of having these webinars. Even the website puts up certain new standards on ESG, carbon emissions calculators. So many of these initiatives, ICI is already doing a good job of it. But what incremental can be done from a suggestion standpoint, which is subject to evaluation and a personal view at the end of the day, is basically to work more closely with regulators. Obviously, it's already happening. But whether we can look at collaborations in terms of ensuring that if ESG audits are being done, let those ESG audits only be done by professionally qualified chartered accountants. That can be one thing to look at. The second thing to look at can equally be to ensure that the certificate course or the education which is there is given that right level of recognition. Like ICI did a very good job that when forensic audits have been done, and SEBI came out with a rule that, okay, who can be qualified forensic auditors? The qualification of ICI was called out as being a acceptable qualification to the regulator. The same approach can be adopted even here. Again, where ICI can equally work closely with regulators is that, again, today it's very common to see that in many organizations, and this is a personal view, you come across a factor that you'll always have a chief financial officer, you'll always have a chief human resources officer. Question is, how many organizations today are having a position titled chief sustainability officer or chief ESG officer? Even today, not all organizations have that. Now, what ICI can do successfully is to try and work with regulators. And of course, these are only suggestions because that's the question that has come, is to work closely with regulators and maybe make this position mandatory as a KMP position, so that way you have fixed accountability on a person. That way you give a flip to the profession. Because the point is, if you can have a chief audit executive, if you can have a chief financial officer, why not also look at chief sustainability officer? So these are some of the few ways that maybe already the level of activism and the level of recommendations which is already fantastic at ICAI's end can even be up to one level further. Yeah, Priya.
If you were to design a risk management blueprint for next decade, what three pillars would define?
One would very clearly be ESG and climate risk. That would be the first pillar. The second pillar would be geopolitical risk management. And maybe if I talk about the third category of risk, it would be I think there are a lot many more options since the question is to select three questions or other three factors. That's what I'm thinking. Two are very clear. I think the third one I'll be keen to go with AI maybe. The entire AI risk posturing. That would be something that, maybe we can look at implementing as the third broad cohort in this case. Yeah, Priya.
In online, what is the next big evolution you foresee in ESG risk management by 2035?
No, you'll have to repeat that question, Priyal. I couldn't get you.
In online, what is the next big evolution you foresee in ESG risk management by 2035?
I don't know. There is some. I'm losing some words you're speaking. Go again, please.
In one line, what is the next big evolution you foresee in ESG risk management by 2035?
Evolution is very clearly in one line. It will be climate change risk management. That's how I would answer the one line.
How can CA support boards and management in embedding ESG risk into internal control systems?
No, that's exactly what we discussed, right? That whenever you are evaluating, whenever you are evaluating things in the lens of your risk and control self assessment or your internal control, the biggest challenge is that you tend to get very focused on operational risks only. How often are you delving into the ESG risk? So the only way you can do it is to ensure that even ESG risk becomes part of your risk register and it becomes part of your entire samples testing process. Till you do that, you will continue to struggle. The moment you integrate that as part of your compliance substantive testing, the moment you build that into your risk registers, the moment you start building preventive control structures around the same, that's the only way you will be able to build it into your internal control frameworks. The thing with ESG is that the world is still coming to terms with it. We are used to the traditional risk areas a lot because those we've seen, we've tested, we've seen that. The world is still trying to learn what exactly is this ESG story. But all in all, it looks in a very, very positive space. And I think that invariably, the CA community will have a very big role to play. Actually, I can tell you for a fact that I met a lot of practicing chartered accountants, I think, in the last 1 month. And so many of them told me, we have dedicatedly formed only an ESG wing or a BRSR wing. And we've got specialist partners only who look at that. So that itself shows the inherent scope. And remember, it's not like your audit, which has been there since existence, since decades. This is a new phenomenon, and if it can show so much momentum in times to come now, then you can well imagine what the future holds for you. Yeah, Priya.
1 minute.
But happy to see so many questions coming. Wow. Go ahead. Yeah.
What skills and competencies will finance professionals need to manage integrated ESG and business risk?
Well, one is that you'll have to get a very strong grip on what are the core nuances of ESG, understand the subject, because make no bones about it, like any other subject, it equally has technicalities. So you have to spend that bit of time, invest that bit of time to understanding that. Now, that could either be by way of pursuing some professional qualifications, or maybe just being more aware of what's happening around the world in that, what are your global regulations around that space. Above all, what are the best practices in that space which organizations are adopting? Once you do that, then maybe you can gradually begin with mid-sized companies, move to the larger end ones. Again, what is extremely important is ESG is very sectoral. So what ESG will be for an automobile company may not be for an insurance company. So again, when you look at evaluating the paradigm, you equally have to understand what is it sectorally specific, and then build capacity around that and then do it. Yeah, Priya.
What are the effective ways to embed ESG risk management into internal control system and operational risk processes?
We did cover that in the earlier question. It's the same approach. So, and a part of it in the presentation, the way to do it is when you're doing your risk and control self-assessment activity, when you're doing your process walkthroughs, and when you're deliberating on the inherent and residual risk levels with the auditee unit or with each stakeholder team, and this would apply whether you are a practicing CA or you are working for a corporate. I mean, for that matter, many things that I spoke about earlier, which I expressed in the lens of maybe the practicing community, equally in some shape and form can be embodied even to the people who are working for corporates, the CS. And that's how you look at the ESG side of it while evaluating risk and control self-assessment. When you're sitting with each stakeholder team, understand what their ESG risks are. Ask them what their controls are. Try and do a progressive analysis as to where they were 3 years back and where they are now. And have they run the mile? Yeah, Priya.
How can organizations integrate ESG risk indicators into existing risk dashboards or scorecards?
That's how you do it, right? I mean, you basically give an X amount of weightage to it. I mean, just to give you an example to put some numbers around the same. If earlier you used to give 40% weightage to operational risk, 30% to market, 30% to credit, such that your total comes up to 100, maybe you may want to relook at the weightages. You may want to give 20% weightage to ESG and in a carefully calibrated way reduce the weightage you give to the others. So that way you suitably integrate risk to your entire ESG into your entire risk framework. Earlier, your risk scores were not looking at ESG. When you gave, say, a risk score of 80 out of 100 to an organization, that was purely based on what they did in the operational, market, credit, or strategic side. Now, maybe that 80 may go up to 84 or even may come down to 76 the day you start building in ESG considerations in it. Yeah, Priya.
How can risk management teams collaborate with sustainability functions to ensure consistency in ESG reporting and control?
Well, it's a very sharp question. The only way you can do it is by, I mean, as much as it may sound very cliche, there has to be a collaborative approach. You try and set up an internal working group. You try and set up an internal working committee or ExCom, which comprises of representatives of these function, and ensure that whenever any risk management reporting is done or whenever any sustainability reporting is done, before it is put out to the world at large, it is run past the stakeholders of this executive committee. So that way, if the sustainability guy is making a contention, which fundamentally is not okay with the risk management guy, you suitably discuss that in the executive committee meeting. And likewise, even the risk guy is expected to bounce it with the sustainability professional. That's how you can look to build it. But yes, good question to ask. The problem comes up, but you have to navigate around it. There's no straightjacketed answer to it, except more and more collaboration, more and more shaking of hands across the table.
How
Yeah, go ahead.
important will data analytics and AI be in shaping future ESG risk management strategies?
Of course, it will be very, very important now, because today, if I want to know what are the good practices of different organizations, earlier I used to have to go through large, lengthy reports, do all of that. Today, AI is definitely doing that job for me in terms of evaluating 50 possible reports of 50 leading ESG players and giving me a fantastic executive summary in 5 pages that what are the best practices which each of these 50 people are doing. So definitely AI will help in that. Data analytics will again help you because data analytics comes in because you have to benchmark with your competitors. Something as simple as the earlier example which I gave that, if your receivables today are say on an average 60 days, your data analytics will help you understand okay, what is your competitor group doing. So if I come from an insurance sector which comprises of 34 companies, it's not enough only for me to know what I'm doing, right? I equally want to know what my other peers are doing. If I am at 60 days, example, are they below 60? Are they higher than 60? If the greater cohort is higher than 60, why are they higher than 60 or why am I higher than 60? Now, for to effectively do that, you need the data analytics. So definitely data analytics and AI will help you do your job better. But remember, you cannot get so blinded by it because the inherent problem with data analytics is that very often it gives you the false positives and the false negatives. And even the inherent problem with AI is that to what extent are you using AI in an ethical way and to what extent are you recalibrating your AI models on a regular basis to ensure that it is giving you output which is representative of the situation at hand. So to that extent, it's good to trust, but as the old saying goes amongst us as chartered accountants, trust but verify. So keep checking. Yeah, Priya.
How as an internal auditor, we can help organization in implementing the ESG framework?
The same way that in terms of just ensuring you are very adequately correct, in terms of validating that whether the organization is actually walking their talk. As an internal audit, third line of defense, the expectation is that you give that level of assurance to the management reassurance function, as we call it, that what the management is proclaiming, they are following. That's the best way you can do it. Now, if you even want to up your game even more, the best way you can do it is do a critical evaluation of what peer group companies are doing. Recommend to the management, okay, peer group is doing XYZ. Maybe you're doing only X and Y. Why don't you look at Z also?
How employees can extend to ESG besides organization responsibility?
Something very simple, like to what extent are you maybe careful about the usage of electricity in your office? Before you, since this more talks about personal, the question is more at a personal level. Before you walk out of the meeting room, did you check whether the lights are shut? Can you look at doing carpooling instead of coming alone? So that way you minimize your carbon emissions. Are you as an employee making a conscious call to reduce paper usage? So there are a lot many things that individually as an employee you can do. On a lighter note, as the old saying in Hindi goes, "Boon boon se banta hai sagar." So never try to think, ke bhai, as an alone as a guy, what can I do? Every guy has a role to play in ESG. Every individual has a role to play, and it is all put together which contributes to it.
What are benefits of doing ESG audit to the company?
The biggest benefit is that you're giving the sense of reassurance, na? That everything that you're reported is correct. So it helps the organization to know where they need to strengthen their processes if at all they are not strengthening, or if at all there are any lacunae witnessed in the reporting. Above all, it gives even you the benefit to the organization is that eventually every organization is driven by your, to a very large extent, by your investors, and investors get a lot of confidence when there is an independent third party audit done and the third party audit says that the organization is doing a good job. So definitely it benefits the organization. Not second guessing that at all.
Many times ESG is evaluated commercially. How to convince leadership teams to pursue ESG or sustainability and not only look at profits? What
So
are your
that's
guidance?
guidance is the one that I briefly covered earlier, which I preempted. It always that question comes. So I'm not surprised it came again. And that's why I tried to cover it in the presentation. That give them inputs on how the good ESG companies are actually delivering better ROAE. What is ROAE? It's basically your profit by your capital, right? That means if your profit by your capital is good, means the overall health of your business more often than not is on the right side of the coin. Make that pitch to them. Show them the ROEs of the companies who are doing well in ESG. Show them the ROEs of the companies who are not doing well in ESG. I can tell you that there will at least be a 20% delta in terms of if you take the score of your ESG companies who are not good in ESG. The companies who are good in ESG will be at least delivering 20% higher ROE compared to the companies who are doing that. And you can check that on public domain. You don't need to go by, as we say, while I know the numbers by heart, but do your independent evaluation. You tell them that you get a better ROE, you'll have their ears. I'm pretty sure about that. Out of personal experience, I'm saying that. Okay, it's a journey. We all run the mile.
Can organizations have threat from authorities on non-compliance of ESG in coming days?
1010% you should. Absolutely, you should. And that integrated with the earlier question, Priyal, which was posed on what can ICAI do? This is another area that ICAI can actively work with regulators in terms of ensuring that if organizations are doing any form of greenwashing, then you basically look to crack the whip in terms of making organizations accountable. So even if you see the glide path of SEBI, initially they began with BRSR disclosures for certain companies. They then extended that. Then they brought in third party. Now, if your report says that something maybe is wonky or maybe you are not up to the mark in terms of what you should do, definitely I think organizations need to be extremely worried. If you're putting out something to the world at large, you're putting out something on public domain and you're not following it, well, in one word, God save you.
How do you vet company performance of ESG?
There are multiple ways you can vet it. One is overall basis, what are the core matrices, which is what we had in terms of key risk indicators. Progressively, are your ESG risk scores improving? What is the rating which external agencies are giving you? Is your carbon emission count per employee coming down? Is your male-female ratio improving? Are you undertaking trainings on climate risk management? Have you improved your renewable energy consumption? Have you reduced sourcing business which maybe has something to do with coal? There are many considerations you can use. There is no one particular answer to it, but what you can do is sit with your management committee, sit with your ExCom and maybe come out with 10 key indicators, which will again be specific to the industry and the company, which you can take as baselining.
How do you build an ESG framework that is future-proofed for tomorrow's economic realities?
Through continuous calibration and recalibration. That's the only way you can build it, no? So ESG is not about saying that I will do it today and forget about it for the rest of the world or the rest of the week. It's a 24/7 by 365 activities where the simple answer to that is keep your eyes and ears very, very close to the ground, interact with your peer group, interact with what's happening in the world, continuously keep recalibrating. One is that when you look at the posturing, see where you were 10 years back, see where you are now, understand which are the risks which confront you as of today, and try and build those into your ESG risk assessments. That's the only way you can do it. Future proofing is never something that you can do if you only look at a thing once in a while. Future proofing means you're continuously in the money. You're continuously updating, re-updating, and doing all of that.
So we are done with the questions now. I'll move forward with the vote of thanks.
Okay, thank you so much. Wow. Really happy to see so many questions coming. Great to see.
Good evening, everyone. On behalf of Sustainability Reporting Standard Board of ICAI, I extend my sincere gratitude to each of you for joining us today for the enlightening webinar on Embedding ESG at the Core Risk Management Blueprint for the Next Decade. Your participation has been instrumental in making today's session a success. A heartfelt thanks to our esteemed speaker, CA Delzad Dinyar Tanas Jivasha, for sharing his deep expertise and perspectives on environmental, social, and governance factors are redefining business resilience and stakeholder trust. Today's deliberations helped us understand how ESG must evolve from a peripheral reporting requirement to a strategic pillar of enterprise risk management. The discussions gave an in-depth perspective on how organizations can integrate ESG into their core decision-making framework, from identifying climate and social risk to developing proactive mitigation strategies, strengthening governance mechanism, and ensuring long-term value creation. Your insights on linking ESG metrics with business performance, regulatory compliance, and investor expectations have given us much to reflect upon. As we close, let us reflect on the key takeaway from today's session. Embedding ESG at the core is not just about compliance, it is about building future ready organizations that are risk conscious, opportunity driven, and value creating. Special thanks to our participants whose engagement and thoughtful questions enriched today's discussion, truly turning this into a collaborative learning experience. Emphasizing that the next decade will belong to organizations that embed sustainability into their DNA, not as an afterthought, but as a driver of innovation, competitiveness, and risk preparedness. We invite all participants to join us for our upcoming webinar scheduled on 6th November from 4 to 6 p.m., where we will continue exploring critical topics in sustainability reporting and best practices. Once again, thank you for your active engagement and thoughtful contributions. Your dedication to advancing sustainability practices is invaluable. And we look forward to your continued involvement in our ongoing initiative as we collectively pave the way towards a more sustainable and resilient future. Thank you, sir.
Thank you. Thank you, everyone. Best wishes to you all and families. Thank you.